This video was brought to you by Brilliant. Houses in the UK have been ridiculously unaffordable for a while now. Last year, the average house cost 9 times the average UK salary, the highest since 1876, and the problem was even more acute in places like London, where the average house now costs something like 13 times the average salary. However, as interest rates have gone up and mortgages have become more expensive, demand for housing has cooled, and last month the UK saw its sharpest drop in house prices since the financial crisis. Banks and estate agents were already expecting a further drop in prices, but with inflation higher than expected, and the new OPEC Plus cuts, which will put even more pressure on prices, it looks like interest rates are going to be even higher, and there's even some talk of a full-blown housing crisis. So in this video, we're going to have a look at the UK's current housing crisis, why prices are falling, and whether they might fall a lot further. So let's start with a quick overview of the UK's housing crisis. We've actually done a video on this before, so if you want to know more about the UK's housing crisis, then go watch that. But the TLDR is that house prices have been rising faster than wages since at least the 90s. Historically, the ratio between median house price and the median income has sat around 4, which means the median house used to cost around 4 times the median annual salary. Today, however, the average house costs 9 times the average salary in the UK and over 12 times the average salary in London. Now, this is bad for a few reasons. High house prices exacerbate intergenerational inequality by advantaging wealthy, older homeowners at the expense of the younger generation. They also exacerbate bog-standard wealth inequality by restricting the privilege of homeownership to those with wealthy parents. Today, over half of all-time buyers under 35 rely on the bank of mum and dad, and this figure rises to something like 75% in London and the South East. It's also just bad news for the economy, because people spend way too much money on housing instead of productive activities. There are lots of contributing factors to the UK's housing crisis. Wage stagnation, the Green Belt, the UK's complicated case-by-case planning system, the Big Five volume builder oligopoly, the lack of social housing, and Thatcher's infamous right-to-buy schemes have all pushed house prices up ahead of wages. Things haven't been helped by the low interest rates we've seen in the 2010s, which make taking out mortgages cheaper, putting even more pressure on the market. However, as inflation has kicked up around the world, central banks have raised interest rates to try and bring it down. This has affected the housing market in 2 ways. First, it made borrowing money from banks and taking out mortgages more expensive, therefore reducing demand for housing. Second, it's made servicing pre-existing mortgages more expensive, which will increase supply. Basically, because about 25% of homeowners in the UK have so-called variable rate mortgages, which reflect changes in the interest rate, their mortgage will all of a sudden have become way more expensive, which will force some of them to sell in order to downsize to a more affordable property, thereby increasing supply. This is especially true in places like London, where people spend a greater fraction of their income on mortgage costs. Obviously, if demand goes down and supply goes up, houses will get cheaper, and that's exactly what's happening. House prices began falling in September of last year, and have continued to fall since. Between March and February, house prices fell by another 0.8% and are now down about 6% from their August peak. Unfortunately for homeowners, most people expect house prices to fall further in the coming months. This is basically because the Bank of England will probably have to push interest rates even higher to bring down the UK's stubbornly high inflation. Despite multiple rate rises, inflation in the UK is still way above the Bank of England's 2% target. In February, year-on-year inflation in the UK, as measured by the Consumer Price Index, jumped to 10.4%. Up from 10.1% in January. This will force the Bank of England to raise rates even further, which will push house prices down even further. This is one of the reasons why, when it was reported that house prices fell again in March, most analysts said they thought that house prices had further to fall. The OBR expects house prices to fall 10% in 2024, while both Lloyds and Halifax expect house prices to fall 8% in 2023. Now, that might sound dramatic, but it's worth remembering that UK house prices are still £41,000 or 19% above their pre-pandemic average, and generally way above historic norms. It's also worth saying that all these predictions came before OPEC Plus announced their most recent production cuts. For those of you who don't know, on Sunday, OPEC Plus, the international cartel of oil-producing nations led by Russia and Saudi Arabia, said they would reduce their daily output by 1 million barrels of oil per day, equivalent to 3% of total production. Oil prices jumped to $86 a barrel on the news, and the Nigerian Minister of State for Petroleum Resources suggested that OPEC Plus wanted to push it as high as $90 a barrel. Now, at this point you might be asking, what does Saudi Arabia's oil outputs have to do with UK house prices? Well, if the last few years have taught us anything, it's that high energy prices often mean high inflation. High oil and gas prices caused by Putin's invasion of Ukraine and the resulting disruption to energy supplies have been the driving force behind Europe's record inflation, both because energy accounts for a significant fraction of household spending and because high energy prices push up the price of other things. Agriculture, for instance, is very intensive, so high energy costs mean higher food costs. The UK's recent salad crisis, which led to a rationing of tomatoes, cucumbers and lettuces in most major supermarkets, was partly caused by the fact that European greenhouses couldn't afford the energy to heat themselves through the winter. The point we're making is that high energy prices, especially high oil prices, usually mean high inflation. And if this happens, then the Bank of England will have to hike rates even further, which will mean even steeper drops in house prices. Now, we're not saying that this will definitely happen. After all, OPEC Plus has proved remarkably fickle about these sorts of things, and markets are currently feeling pretty relaxed about it. But it's yet another risk to the UK's vulnerable housing market, and it's worth saying that inflation has already proved harder to tame than central bankers and policymakers expected. If they'll be able to get a handle on it going forward is anyone's guess, but as a non-homeowner, I hope they make good decisions in the next weeks, days, and even minutes. But while we're waiting, it only takes a few minutes every day to massively improve your skills and safeguard your career against artificial intelligence by investing in your human intelligence, and that's where Brilliant.org comes in. Brilliant.org is the best way to learn maths and computer science in a fun and interactive way. Brilliant has thousands of lessons, from foundational and advanced maths to AI, data science, neural networks, decision-making and more, with new lessons added monthly. That logical decision-making course is super interesting too, using principles from maths and science to help aid how you reach your own decisions. Not naming names, but maybe some politicians need a Brilliant account. Anyway, you can try everything Brilliant has to offer, free for a full 30 days, by clicking the link in the description. Plus, the first 200 of you will get 20% off Brilliant's annual premium subscription. Thanks for your support and for watching TLDR.